All right, I think we can go ahead and get started. I want to thank everybody for joining us today. This is our first quarter 2026 market and economic update. Thrilled to have our Chief Investment Officer, Brian Burton, on with us today. And we've got a little bit of a different format than what we've done in previous quarters. I feel like I've been getting a lot of the same questions from clients, particularly over the last, call it 2 months, just about why the market's behaving the way that it is, what factors are at play. And then particularly from Jan 1 to now, we're called 6 weeks into the year. We've had a little bit of a yo-yo market with the S&P more or less flat on the year to date. But at the same time, we've seen a diversion in asset class performance year to date. So I wanted to get Brian's opinion on one, how he would answer these questions that we continue to receive, and sort of looking forward where we're going to go from here. So Brian, thanks for joining us today. And I've given him a little bit of a heads up on this, so he's prepared some good content on these questions. So Brian, anything you want to say before we get started? You want me to jump right in?
Yeah, let's jump right in. Just thanks to everyone for joining. If you're watching live or on the recorded version, we're glad you're here. A lot to talk about, so let's get right to it.
So the first question that I wanted to get your response on, it's one I've been getting for several months, and I think there's a little bit of politics wrapped up in this question, depending on which side of the aisle you might sit. But I do get the question, why is the market continuing to be so strong? I mean, specifically 2025 on the back end of 2024 being very good. And we saw that dip in April of last year, and then really a strong recovery immediately after, and then through the end of 2025. So if you had to pinpoint two or three reasons why the market did so well in 25, what would your answer be?
Yeah, I mean, there's definitely multiple factors at play here. I think the most important thing to do, and you mentioned the political side, the noise we're hearing on that side, and then also the geopolitical concerns that are out there. It's easy to lose sight of really the backdrop, the economic backdrop that we have currently in the United States, which is, believe it or not, it's rather benign and boring. So we've got pretty steady, economic growth. We've got pretty low interest rates, even expected to go lower with two more cuts priced in this year. We've got a labor market that's pretty healthy overall, unemployment rate at 4.3%, and not much sign of a recession in the near term. So what we have back behind us is a pretty strong environment for stocks to move higher, and that's exactly what we've seen. In addition to that, we've seen relatively strong corporate earnings growth, 12% year over year on the S&P 500. So companies are becoming more profitable, allowing them to reinvest in their businesses and reward shareholders at the same time. Also, consumers have remained pretty resilient. Spending data is still pretty strong, and consumer confidence is actually on the bullish side at the moment. So definitely a lot of factors at play. Markets have been strong in the U.S. and abroad in 25 and so far year to date, on the back of all these tailwinds that we've seen.
I wonder too, it feels like for markets to have these prolonged, upward periods, there needs to be some sort of like a theme behind why the markets kind of have momentum and continue to have that momentum moving forward. And, the AI investment theme has been obviously very beneficial to a handful of big tech names, but I think just general, optimism that this is going to be this productivity lever that, lifts, all of us, the U.S. and global economies, all together. And I think that's been a big factor as well. So, the tax bill, although politically, controversial, does have some beneficial language as it relates to, accelerated depreciation, and, that might encourage some capital investment by companies. So I have to think that that's also, been a factor as well. Yeah.
Yeah, absolutely. And one of the provisions of the bill you just mentioned is tax refunds for families, individuals our forecast to be an extra $1,000 this year compared to last year. So, that in itself will help, consumer spending in Q2 and Q3. So, yeah.
Great. Good answer. All right. So, and I've got some slides here. If you want me to reference them, just let me know. Uh,
Sure.
so, the question that I don't like answering just because I don't have a firm opinion on it, other than it's an area that we don't, recommend investment for clients in, although I know we have some clients that do that on their own, is we've seen a sell-off in cryptocurrency and a fairly precipitous fall really across the board. I mean, these are coming off of all-time highs, so they're still relatively high to where they were a few years ago. But simultaneously, we've seen a run-up in gold,
Mm.
which is really interesting, as we've heard for the last several years that particularly Bitcoin was considered to be sort of a digital equivalent to gold, and that's kind of psychological safe harbor asset that people might want to own when they're scared of owning other things. What do you read into that? Why the diversion in those two assets that were compared so closely just, call it a year ago?
Yeah, I mean, trying to tell a story around the ups and downs of cryptocurrency is a tough thing to do. Um, but if we just look at the mechanism itself, I mean, we've seen kind of this forced liquidation of these massive leverage positions in crypto derivatives. And when you have those type of moments, unwinding of these positions that are highly leveraged, it can cause this kind of cascade of selling that turns what would otherwise be probably maybe just a typical correction in an asset to potentially a major crash. So that's one element that's part of this, I believe. And then you mentioned another one that I think is maybe just as important or more important, and that is kind of thinking of gold as a store of value or a safe haven asset. When we have these moments of disruption and these geopolitical shocks, you hope your store of value asset holds its head up, right? And what happened with Bitcoin and other cryptocurrencies is during these periods of uncertainty, it's traded as more of a high risk asset than it has a store of value.
Mm.
So when you lose that, I think you said digital gold is kind of the thesis of this asset. That it loses. It loses its luster, for lack of better words, and that's part of it. We've also seen kind of this more risk off sentiment in these situations. So, not that investors are necessarily selling out of equities, but we have seen kind of this repositioning into safer equities. So moving out of some of these, major tech companies, these AI related names, and more into your typical traditional value stocks where valuations look a lot more appealing. You're getting a dividend, which matters when interest rates are falling. So this broad risk off sentiment. And then with gold, if you'll actually, John, if you'll show slide 6 first, which will show kind of this crypto. This is just Bitcoin in particular over the last 6 months. So you kind of see this, 42% sell off in 6 months. And if you flip to the next, you'll see pretty much the inverse with gold up 45% over that same period. So money's been moving out of Bitcoin and other cryptos and into gold. It is the safe haven. There's demand there. You've also had, central banks around the world have been buying gold. It's just you've just seen this massive shift, and it's kind of, gold is really at the moment it's performing its traditional role, which is a hedge against currency devaluation. Investors looking to protect capital. We've seen the weakness in the dollar, and gold is going up. So it's not necessarily hard to believe that we've seen this, but the move itself, the velocity of the move is a little more drastic than what we would expect to see in precious metals.
Yeah. I mean, you and I were chatting the other day, obviously it would have been nice to buy Bitcoin when it was, $100, but
Mm.
so we missed out on that. But just from a fundamental investment standpoint, thinking about how you value these assets, I think that's the one thing we've always struggled with is, we can't tell you if 67,000 is an appropriate level. I mean, when we look at a company, we can look at underlying earnings, current earnings, past earnings, future earnings potential, projections forward. When you're looking at an asset like cryptocurrency and gold too, very, very difficult to understand like what is the actual true fundamental value of the asset. And, it will be really interesting to see if this prolongs from here because I fear that, some of the investment that's happened into the crypto market has been from individuals that maybe did not quite understand the level of risk that they were taking on. One thing from an investment standpoint that we know is makes it that much more challenging too is, we 13F filings, we have to file them every quarter. That tells us the holdings that we manage for our clients in aggregate. So if we own a number of shares of Apple, we've got to publish that. The crypto market's a black box. No one really knows who the primary holders of this asset class are, and that I think is a one of the key offering points of the asset class is that it's out there on its own, but at the same time, like the transparency in the public markets, I think increase the confidence and actually simmer the volatility a little bit simultaneously.
Yeah, no doubt. And what we've also seen more recently is that the institutional side, the buying on that side has actually declined. And I think part of that story is just the regulatory uncertainty around the asset itself and what that's going to look like down the road. And big institutions don't really want to own assets typically that they don't understand or that they don't know what the regulatory environment is going to look like down the road.
Yeah, good point. All right. Next question. So AI was the theme of 2025. I think I read an article that, I mean, there's been a few different metrics that have been brought up, but something like 30% of GDP growth in 2025 you could attribute in some way, shape, or form to AI investment. That could be, chips being purchased. That could be, uh, you know, power sources being created, for these data centers, which is made for a really interesting market. But we've seen a little bit of a change going into this year. Some of the tech stocks, not all, have shown a bit of weakness. What do you think's going on, and how do you think this might continue or reverse?
Yeah, so if you think about AI, what we refer to as a hype cycle, right? So really, that lasts for a couple years typically on an investment theme, new technology. What we've seen is we had this massive run up on hype, and that started really in 2023 with these inflated expectations, and then what happens is we've moved past that and we're into a more like realistic, mature phase of implementation. So what that means is, instead of the speculative, magic solution that of AI, it's moved towards a more practical, ROI driven focus. And investors are now looking for what is the return on these massive investments going to look like, and there's not a lot of certainty around that, and quite frankly, it's very uncertain. So, the chart you're showing here is really amazing. If you look at the capital expenditures of these 8 companies, it's forecast to be $637 billion next year. So, I mean, it's just really just mind blowing numbers and money that's being thrown at this. Um, so it's hyped to reality. It's also, where is this going? The industry's moving away from, this generic large language models that have really kind of been all the talk and hype of AI to a more agentic AI. Um, Despite all the hype still around all the AI agents, but it's really this transition that investors are very uncomfortable with at this point. And we've seen money start to move. We mentioned just a few minutes ago this kind of shift. Um, John, if you'll pull up slide 4 for me. Uh,
Oh, did I lose my share there? Let me do that
okay.
again.
But what this slide is looking at is how narrow the S&P 500 leadership has gotten, over the last, call it 10 years. So we only have to go back to 2015 to see where the top 10 largest companies in the S&P 500 made up about 19% of the index. You fast forward only 10 years, and those top 10 now make up almost 41% of the market. So what that means is for every dollar that we throw into the market, 40 cents of that dollar is going into just those 10 companies. So
Is
this
this
is a
is
this
this
is
the
a
right slide?
serious concentration at the top of the index. You think back to, at the start of this chart goes back to 1990. You know, then the top 10 made up less than 20%, and no single industry at that time dominated. It looked, the S&P 500 looked like a far more representative cross section of the U.S. economy than it does today. So, some of the air has got to come out of this, and I think valuations in anything linked to AI have gotten kind of out of control, look extremely expensive. So part of it, I think, is just is taking some gains and moving into some maybe safer areas in the market. But AI is going to face more challenges in the years to come. And like I said, we're over the hump when it comes to the hype around it. So we're going to have to see results.
Well, it's got a long way to go. I was on a call with a client about an hour ago, trying to call an insurance company, and we had an agent, an AI agent, that was speaking with us, and it was a very frustrating loop that we ended up not accomplishing
Right.
anything through. So I think there is a little bit more investment needed before it's doing the job of a human. I did want to point out on that one slide, thought it was interesting. If I could find it. Um, on the cap investment,
Mm-hmm.
it's really interesting. I love this slide. It's really interesting if you project forward or the projections forward. And a lot of this has come out of the announcements from these companies, Amazon, Alphabet, Google has come out and talked about the level of investment, Meta, Apple being very minimal, compared to, and that's interesting because if you think about what they are now and the way they generate search, Google pays Apple a significant premium every year to be on the iPhone. You wonder if they're envisioning that that will be the case moving forward. It's just going to be in a different form, maybe Google's AI. But there's clear opportunity, and I've mentioned this in previous calls, that these companies see, but a lot of it is also defending their turf. I mean, if you're Google, there's not been a bigger threat to arguably the best business model in the world, which is Google, with the amount of cash that they generate. But they also have a lot of risk if people start to get their information via AI sources in the future, not using essentially what's paid search, which is what generates so much, for Google. So, and you brought this up. I think it's probably 3 months ago. It was a small release inside of a quarterly earnings report, but just talking about how cash was no longer free cash flow was no longer being utilized for a lot of this reinvestment, that they were now starting to lean on the balance sheets of some of these companies and raising debt in some instances to come up with the capital to reinvest into AI. And that is when the market starts to question the ROI. When are we actually going to see some amount of return or gains that would come from this level of investment? Because that's what markets do. They'll give you slack for a while, and then all of a sudden we'll tighten up the aperture and say, you've invested $100 billion. Let's, where's the return on that? And I get the sense that that might be happening a little bit with some of these names.
Definitely.
Yeah. All right. One more question. international investments have been unbelievable last year, both at the developed international as well as emerging markets in 2025, outpacing US. And then we've seen just an unbelievable start to 2026 in both asset classes after years of somewhat, meaningful unperformance versus domestic markets. Um, what do you attribute that to? Because, well, I'll just stop there.
Yeah.
I got my opinion on
Yeah,
this.
it's interesting. The cycle of international outperformance has really started a little over 2 years ago. So, really, post Great Financial Crisis, um, U.S. markets have trounced international and emerging, for that matter. So, some small part of it is likely mean reversion, which we are believers in. But you've also had some other factors at play. So. Um, Obviously, a weakening dollar is beneficial to international stocks. Increases the value of foreign earnings and assets for U.S. based investors. You've also got valuations that are pretty attractive, especially relative to U.S. markets. Um, they're trading at a discount, providing that value investors are seeking. It also, for so long, we've had, if you look at the correlations between US returns and international returns, you've seen that correlation get tighter and tighter and tighter and tighter for probably the last, call it 30 years. What's happened of late is that the US market is so tech heavy now, and in particular AI, that you're actually starting to get, believe it or not, some diversification benefits from owning international stocks once again. So I think we've seen some money flow in for that reason. It really helps to counterbalance. If you're an index buyer and you own the S&P 500, owning international helps counterbalance some of that tech heavy U.S. market exposure. Um, so a few things going on there. I think just some good opportunities overseas, and just asset class has just been beat down for so many years that investors have been flocking to of late. So yeah,
What
it's
do you read?
somewhere.
What do you read into this chart?
Yeah, I mean, this is just an example of what we're talking about. So USP ratio on average 40% higher. So I mean, valuations in the U.S. and I think so much of that is just some of the tech stuff where valuations have really gotten extremely stretched. When you blend that with the aggregate market, you're seeing an overall PE that looks pretty expensive at this point. And so yeah, I mean, you look at the the international PE ex US. Go back to late 22 when the market was in a trough. I mean, you're trading sub 13 times earnings on the international market. So, um, pretty good opportunity if you can block out some of the noise that goes with investing overseas at the moment.
I mean, it's clear when you see the U.S. forward PE ratio. So that's current market price divided by the amount of earnings expected for the U.S. market next year, trading at almost 28. That to me, feels a little stretched. I mean, versus historic norm, but also I think paints a picture of a market that has an expectation of growth. Really, that type of PE ratio is hard to justify if there isn't some expected growth from the U.S. economy and corporate earnings. That would be well above historic norm. So, and even on the international side, you can see kind of the trend line. This only goes back to 2010, but I think that expansion is it's exciting in some ways because clearly there's a considerable number there are a considerable number of people out there who believe that the economy and the markets will continue to do well, and the underlying companies, more importantly, But also it makes the markets a little more fragile, when you put these expectations on it on a higher P ratio like that. So I think each quarterly report this year is going to be a little more sensitive. Markets will be a little more sensitive to it than they were last year. So
Sure.
you've got some other slides in here. I don't want to skip over anything.
I think we covered most. I mean, this slide here is just really showing how if you're looking at like a long-term trend line of this chart. So think about 2003 to 2023. You can see that I'm sorry, this is So market cap weighted index underperformed equal weight over that 20-year period from '03 to 2023. And since then, though, we've seen this just massive outperformance by market cap weighted. So market cap being the S&P 500, the biggest companies make up the largest percentage of the index. So we've positioned ourselves to try to take advantage of that. We think we'll get a little bit of quick mean reversion there back to the norm. These run-ups where market cap trounces equal weight typically don't last very long. So that's just to show how much outperformance. If you just owned, the top 10 names in the S&P over the last 2 years, you've done really well. If you owned the other 490, they were pretty much a waste to your portfolio. So we think we're going the other direction here.
We had one question come in, by the way, about energy. Specific impact from data centers from these AI companies, both cap expenditure. Does that show up in AI or energy market? Basically, we know that the bottleneck to AI is likely energy, and we've heard a lot about that of late. Where are we seeing that show up? Are we seeing that show up in the energy markets right now? Or are we seeing that show up in the tech companies making those investments?
Yeah, I mean, if you look at, some of your energy companies over the last, call it 12 to 24 months have absolutely ripped higher. You look at, across the board, and you got to think too about the utility companies. So, you've had your public utility companies trading, running up 25, 30% in the last 12 months. So I think there's benefactors on both sides of that. Your old energy companies as well as utilities, and then obviously the AI companies. Really until late, any company that has the smallest tie to AI has, for the most part, benefited just from being tied to it.
I think there was actually a study last year that said that anytime AI was mentioned in any sort of quarterly report, that there was a correlation with an up day to follow. That's how every CFO that was in a quarterly earnings report, I think felt a responsibility to figure out how does, even if their company seems so far removed from AI, thinking about how they could leverage it, moving forward. So, well, I think that's it, Brian, unless you have any other comments you'd like to make before we close it out.
I don't know. Looking forward to a good year. Appreciate all y'all listening in and your trust in us always.
Yes, absolutely. Thank you all for joining. We will be posting this recording, and feel free to reach out if you have any questions. Thanks for your time.
Thanks.